All right, good evening, class, and welcome to our taxation class this evening. This is our first class in this series of refresher class. We'll be looking at a topic called basis period for companies and businesses. Okay, first of all, my name is Chima, and I'll be your second lecturer for taxation. So let's look at taxation of business income. What we mean by business income is any income that you get while doing business. Okay, so that business income could include income from a sole proprietor, a one-man business. It could also be income from a partnership business. It could also be from a limited company. All of these are business income. So they all have the same format, the same way of calculating assessable profit. Now, the difference between the treatment of a sole proprietorship and partnership and limited company is this. For sole proprietorship, it is just one person. Even though it's a business name, it is the owner that is being taxed. And you use the personal income tax rate, which is that graduated rate from 7% down to 21%. For partnership, is a group of sole persons coming together, and it's still the same treatment, the same way it is being taxed. While a company is seen as a different person on its own, and a company is treated the same way for assessable profit, but the company needs to be charged a tax, which we are going to discuss later. Sorry, I want to also stress that if you are joining in this class, can you please give your name a descriptive name so that I can know? For example, I can see two students. One is Akindele, that's fine. There is David, there is Daniel. The third person I can't find your name, I can only see an emoji. Please, can you rename to your name so that we can know who is there? All right, so thank you as you do that. All right, so we are going to be looking at the business income and how you can assess it to tax. You know, the format for getting the tax of a company, the format for getting the tax of a company is to first of all look for the assessable profit. Once you get an assessable profit, once you look for assessable, you can now look for taxable profits. Then you now find tax. So what we'll be concerned ourselves today is the basis period, how to use the basis period to get assessable profits. All right, I'll be concentrating more on the new Finance Act that was promulgated in 2019 and passed in 2020. The Finance Act 2019 became operative in Nigeria from February 1, 2020. And so that's what we'll use. 2020 now becomes the year of assessment that started the new Finance Act. So if you are given a question in the exam and you see year of assessment 2020, if you are dealing with that year of assessment, you need to remember new Finance Act and act accordingly. The new Finance Act stipulates that all taxes will be charged at based on preceding year basis. All taxes will be charged based on preceding year basis. It means that when we say preceding year basis, let me use example to show that. If you are using a postpaid NEPA bill, and we're in the month of April, this is April 1 now, if they give you a bill in April 1, for sure, it will never be an April bill. It will be bill consumed in the month of March. Yes, while you may call it April bill, because it is being brought in April, money will be collected in April. They will tell you your due dates. That if you don't pay on or before, let's say 15th of April, you'll be disconnected. Now that becomes April bill. But the service period is from March 1 to 31st of March. Now, what is it called? It's called preceding month basis. Now, you can get to understand this preceding month's basis to, let's use it to explain preceding basis. So it means that if the taxman is visiting your office, collecting your tax, pursuing you to your tax in 2022, it's going to be on preceding year basis. The service period must on a date in 2021. And so let's say you are running a 12 months accounting period that starts from January 1 to December 31st. So December 31st, 2021 becomes the final date any account can end for it to be chargeable in 2022. So we can say, for you to have a 2022 bill from the taxman, yes, I can call it a bill. It's an assessment notice. In this class, let's call it a bill. So for you to get a bill from the taxman, you'll be looking at your books ending on 2021. So you're going to be choosing any 12 months that ends 21 to make it preceding year basis. So you could decide to choose January 1, 2021 to December 31st. It's all fine. You can decide to say you want to use December 1, 2020 and end in November 30, 2021. You're all fine. You can decide to say, oh, I want to start 2020 and end in January 31, 2021. You're all fine. You can decide that your accounting year will end in January. That means it must have started in February the previous year. Now, the important thing to identify preceding year basis is the dates your account is being made up. So if your account service period, which is the date is being made up, if your account service period ends on any date in 2021, you are due to pay the tax in 2022. You are due to file it preceding year basis. Now, it doesn't matter whether you are starting your business now or it's an ongoing business or you are ending the business. for all accounting period, it must be on preceding year basis. Now, this updates what we usually have in the old dispensation, where we used to find it difficult sometimes to understand basis period, and sometimes we have overlapping basis period first year and the second year, and between the second year and the third year. In the new Finance Act, there is nothing like overlapping. We'll get to see it. Now, something you should know in the new Finance Act here is, if we are used to the old one, in commencement of business, we usually have something called right of election in the old Finance Act. Now, in the new Finance Act, we have discontinued the use of right of election. Now, do you know why? Because the law says actual year basis for filing tax is no longer in use. The principle of right of election drives on actual year basis. And so if actual year basis is continued, right of election will die a natural death. And also, another good thing about the new Finance Act is because of capital allowance treatment. Now, previously, capital allowances, which usually does not like gaps and overlap, usually does not follow concurrently the basis period for profits. This is because basis period for profit may have overlap and gap, but capital allowance will not allow that. And so how do you apply the matching concept? Matching the period where you are making your revenue with the period in which you are using the business assets, which you will not have to claim capital allowance. And so you see the need for everything to be changed so that both capital allowances and assessable profit could be in sync together. When we take capital allowances, you will understand what I'm talking about. But for now, let's look at basis period for assessable profit. Now, for basis period for assessable profit, we usually say that the overall accounting principle is base your assessable profit on preceding year basis, ending on the account choosing date. But there are three abnormal situations that could present itself. Now, this normal situation we talked about, which is preceding year basis, ending on the account year end, can only work when the business is not a new one. The business is an ongoing business. That can work. And also, if the business is not dying, that is, it's going to obey the going concern to live perpetuity, especially that of companies, it's going to work. The other thing that will make it work is if you don't change your account year end dates. So these three things are the things that will drive the consistency of your filing using the preceding year basis ending on the account chosen date. So that means that business has three things that drives it. That also means that there are three abnormal situations we shall discuss. The first one is, what if I just commence my business now? How can I apply the new Finance Act? Let's look at a question here and discuss based on the question. If you can see my screen, I want to also ask you to go to the comment section to say you can see my screen so that, and you can hear me well, so that we can go on to solving. All right, while I'm waiting for comments, let's look at the first question. Exercise 1.1. AYZ Company Limited commenced business on April 1, 2019, making up accounts to June 30. Okay. Making up accounts to June 30 each year. The following results were extracted from the books of the company. Now you can see here that period ended June 30, 2020. We have year ended June 30, 2021, and year ended June 30, 2022. And there are figures there required. Compute the assessable profit of the company for the relevant years of assessment in line with the rules of commencement of business and the alternative available to the taxpayer. Now, if you look at the dates, first of all, the business commenced on 2019. Any business that commenced in 2019, any date in 2019, you automatically falls inside the new Finance Act. So any business that is starting in 2019, that is the first year service period that the new Finance Act takes. If your business is starting in 2018, wow, that will be the last period for the old Finance Act. So if your business is starting from 2018, you cannot use Finance Act, the new Finance Act, for the first 2 years. So I want to limit myself to the new Finance Act, so all my solutions will be targeted at the Finance Act. Now, I want to also tell you that in questions like this, look out for 3 things. The first one is, once you see commenced business, you know you are using commencement rule. That's a signal that this is a commencement rule question. Now look for the date of commencement. Now the date of commencement is important. It tells you whether you're using the new Finance Act or the old Finance Act. Now this April 1, 2019, remember I told you that any date in 2019 will fall under the new Finance Act. So you know this is for the new Finance Act. That's fine. So you have seen that commenced is here, commencement rule, the date shows you even Finance Act 1, then you look for the account year end is June 30. So you now know how to draw up your account. So that when you're doing your preceding year basis thing, you will know this is where I'm going to end. Now, one of the things that makes the commencement rule or the commencement of a business to be abnormal is because of this first period we see here. Now, whenever you see period ended, it tells you that it is not exactly 12 months. It's either it is shorter than 12 months or longer than 12 months. And so the existence of this word period, either longer or shorter, makes it abnormal. Because the normal thing for any year is to have 3 characteristics. 1, the accounting period must be exactly 12 months. So you'll be seeing things like year ended. That's fine. Second thing is the account must have only one date ending on the preceding year before the accounting, the year of assessment you are looking at. And the third thing is it must have started where the former accounting period ended. It must have started where the former accounting period ended. So, all right, so now that we know all of that, we find out that this is period ended June 30. Let's review the rules for the commencement of business. The first year of business, you need to look at when the business starts. That's when your service period starts count, and it is going to end on the next available accounting year end of your business. So it means that if a business commences on April 1, 2019 and makes accounts to 30, it only means that we have April 2019, May 2019, June 2019. We have 3 to file the first assessable profits. So the first year will contain 3 months, which is from April 1 to June 30, 2019. But here we are saying period ended 2020. That means that it has 3 months plus 12 months, meaning 15 months. That's the first abnormality. Perhaps the only abnormality here because of the new Finance Act. Now, how do we tackle this problem? Now, let's look at the solution here. Let's look at the solution. Right. So if you see that my first year will not be 2019 as contained in the old Finance Act. It's going to be 2020. Why? The reason why you are going to have 2020 here instead of 2019 in line with the old acts, which would have told you to use 2019, is this. Your basis period is from July 1 and April 1, 2019 to June 30, 2019. Now, it's important to look at these dates that is ending. It is a date ending in 2019. And so it means the preceding year of 2020 is 2019. Now, recall the electric bill I gave to you. If they are bringing a bill for April, then April 1, they're bringing a bill for April 2022, it means that it should not contain April. So it's going to be a service period of March that is just ended. And so if you are using year of assessment 2020, we are looking at the books just ending in 2020. So this account year, and that's the third thing, must be the thing that you should watch out for. So you see 2019 here, that is when your service period ends. It means the next year you will be served a bill. So the first period is a 3 months period, and you are given 15 months. So you simply say 3 over 15 times what is given to you is 1,800,000. That means for the first 3 months, which forms the first year, you are going to be assessed to tax on 360,000 naira. That's the first year. Now let's go to the second year. we've established that the first year is 2020, this year will be 2021. And your basis period will obey the normal basis period. One, it is starting from where the first basis period stops. It stops at June 30, 2019. This one will start from July 1, 2019. So that's one. Secondly, it is going to be 12 full months. It's 12 full months. Thirdly, it is on a date prior to the account year of assessment. So you see here that it meets the qualification for a normal basis period, unlike the first year that failed woefully. Now, since it is 12 months, and what was to us was something from we started business till June 30, 2020, and what we are dealing with here now is June 30, 2020, which is 15 months, the account. We've taken the first 3 months in year one. It means that the 12 months remaining will be for year two. So it's going to be 12 over 15 times 1,800,000, giving you 1,440,000. The year three will be the year after year two. So that will become year of assessment 2022. Your basis period will take from where year two stops. You're having July 1, 2020, which is where it stopped the last period, and it's going to continue for another 12 months in June 30, 2021. Note here that because they gave you your account year and that's June 30, you should be doing it for consistent. So you see the first year there's a consistent, second year there's a consistent, third year, fourth year. In the third year, there's no need to prorate because we are giving year end June 30, 2021 rather, and give us 1,500,000. Excuse me. You are giving 1,500,000 and it's year end. So it means that it must have been July 1, 2020 to June 30, 2021. So you see the whole 1,500 is being applied here. No prorating. Go to the fourth year. The fourth year is 2023. The same thing maintains a constant 12-month period ending in June 30 every year. And no prorating is 1,800,000 as given here. And that's the company assessable profit for the relevant years. With since the coming of the new Finance Act. So if it were to be the old Finance Act, the way we want to agree would have been different. I don't want to go into that. And your right of election would have been different from this approach. All right, so that's it for that. We'll go to example 2 to see what happens here. But before I tell you about example 2, we've discussed one abnormal situation that will make you slightly adjust the rules for filing of assessable profits. We said that filing of assessable profits will be on preceding year basis of an account that is 12 full months ending on on the preceding year basis. Now, the commencement rule allows that the first year may be shorter than 12 months. That makes it abnormal, and we've seen that. There's another situation that may occur. I told you, for this new Finance Act to drive well, it must not be a beginning business. Second condition is it will not change its accounting date. But there are certain reasons why you may have to change your accounting date. Let's say, for example, you decided to become a merger with another company. Let's say, for example, there are 5 banks that merged to become Sterling Bank today, or perhaps Access Bank and Diamond Bank, they merged. And let's say Access Bank was using a particular account year end, Sterling Bank was using Access Bank, Diamond Bank was using another account year end, and they now decided that, okay, for the sake of uniformity, let's go and use a particular accounting date. So one entity may have to change, or both may have to change. And what if you have been using an accounting date and government now said, we are regulating the business in this industry, like they did in banks and oil companies. All banks and oil companies, please report your business activities up to 31st December. And if you have been using maybe June 30, you have to comply with that order and change your accounting date. So how do you treat it? In the course of this question, I'm going to show you how to treat year change of accounting dates. All right, Liadi Trading Company Limited decided to change its accounting year end from March 31 to December 31 of each year for administrative convenience. Its 2007 assessment was based on its accounts for the year April 1, 2005 to March 31st, 2006 on preceding year basis. Now, accounts prepared and submitted during the relevant period were as follows. So you can see year, they gave you a 12 months period. You now notice something abnormal. There is a period here, which is 9 months. So once it is less than 12 months or more than 12 months, you have created an abnormality. And that's why we are considering specially change of accounting dates. But let me tell you something here. The new Finance Act 2019, 2020, 2021 did not change anything from how we used to understand change of accounting dates. It's funny, right? Change of accounting date should have been changed, right? But it didn't change anything. All right, so it means that the way we understand it in before 2019 or before 2020 is still the same way we are carrying on now. And how is it? Now, the first thing is identify that year of assessment where you first made a change. So you've been giving your reports, your filings for basis period that ends in March every year. Then all of a sudden, you stop bringing reports ending in March, you are bringing it ending in December. Then you have to ask why. That change, that first year of change, you have to look at that as your relevant year. Then the second thing is to bring 2 years after that. and assess the 3 years. The first relevant year when you notice the change and the 2 years that follows it, you will assess these 3 years based on the old accounting date and also based on the new accounting date. Whichever is higher in your assessment, that is what you should pay to FIRS. All right, so let's look at the solution. Let's look at the solution. Now, we need to find out when there was a change. So you see here that this first year, they gave you as year, 12 months, meaning that it was a continuity of how they have been doing it before. And if you notice here, it was in March 31st that they used to bring. Then the next year, surprisingly, they brought 9 months because March is 3 months into the new year. Then I say, okay, let's not keep doing March. Let's do the next one up to December. So they started from April 1, 2006 down to December 2006, and they achieved 9 months. So that's where you start. You ask yourself, this 9 months period, that I have identified, which year of assessment did it affect? How do you answer that question? You look at the ending date. The ending date is 31 December 2006. And if your account is ending on 31st December 2006, the bill will come the next year, meaning your year of assessment should be 2007. So that's what we have here. 2007 is our first relevant year. Now, truthfully, you have asked for a change, but the tax people will not apply that until the 3rd year when you start applying it. Why? Because of what we're going to do now. First of all, even though you've asked for change, the tax people will want you to bring your filings based on the old dates. It doesn't matter whether you have applied for a new date, keep bringing it for the old date for 3 years. So the first relevant year is 2007. Basis period, it gave you from April 1, 2005 to March 31st, 2006. What you are doing is you are pretending that you never asked for change. Of course, it gives you 120,000. It gives you 120,000, which is this 120,000 we find here. The next year is 2008. That's the second relevant year. The second year starts from where the first year stops and ends choosing accounting date. So we have it from April 1, 2006 to March 31st, 2007. So what happened? March 1st, 2006 would have started, April 1, 2006 would have started from here. This is till December, which is 75,000. But here, we are pretending that you are still going to end on the old dates. So we still have January to June. We've already gotten 9 months. So we need how many more months? We need 3 more months. So you see here, 75,000 is already going to be taken. 3 months out of 240,000 will be taken. So if you see here, we have the 75,000, which represent the 9 months figure, and 2 over 12 times 2,400,000, which represent the 2 months figure and 3 months figure. You add these two together and put the answer here, 135,000, meaning that the second year is 135,000. The third year, you still follow suit what you did in the second year. So what you do now is, the third year, you can see that the question is not coming as superior. It's not coming like, how will I put it? If you look at it here, this is a third year, that is 2007, ending in 2000. You are going to be filing it in 2008. It's a 12 months figure in 240. But mind you, you have to be bringing it on the old dates. So looking at the old date here, April 1, 27 to March 31st, 28, we will need account from April 1, 27. Where can we find April 1? We can find April 1 inside these dates. So these dates start from January. So January will have passed, February will have passed, March passed. April 1. From April 1 to the end of this accounting date is about 9 months out of 12 months. So that's why you see 9 over 12 times 240 plus, this is 31st December 27. We need up to March. So we'll go to the next year. January 1, 28 down to March. It's 3 months. So we'll be taking 3 months out of these 12 months. And if you sum them, everything gives you 187,000. Now, after getting the sum, after getting the 3 years, rather, the first relevant year, the second year, and the third year, you sum them up and you get a figure. This figure will likely be with the tax authority. Then you now do the second assessment based on the new year, the new dates, based on the new accounting date in December. So now you are not doing the right thing. So since we started with 2007 here as our first relevant year, we must also start with 2007. But all accounts must end in 31st December. So it means we'll be looking at accounts from January 1, 2006 to 31st December 26 rather. So let's look at it here. 2006, where's January 2006? Where can we get January 2006? We cannot get it here. We can always get it here because here ends on March 2006. So it means that January is there. So we have January, February, March for that month. So you're going to take 3 months out of this 120, which is exactly what we did. 3 months gone, we need 9 months. And funny enough, the second one is 9 months. So you just bring your 75,000, your 75,000 plus 3 over 12 of 180, of 120. When you tidy it up, everything will give you 105,000. All right. Now that's your first relevant year. The second one, which will be 27 year of assessment. you have to start from January 1, 26 to December 31, 26. Sorry, 27, because your second relevant year is 28. So your basis period must end in December 31, 27. And we are giving directly. We are giving 240. This 240, you just apply it there. And when it comes to the third relevant year, it's going to be from where the first one stopped. Sorry, this is January 1, yes, 2008 to December 31st, 2008. So what do you do? Look at it here. January 1 to December 2008, 12 months is 28,800. So that's what you do. Sorry, 28,000. So you now sum the 3 years. When you sum, you have 373,000. Now, compared to 442,000, which one of them is higher? Your 432 seem to be higher. So that is what the tax man will base your assessment on, the basis period that is higher for providing tax to the government. How do you know this question is how will I call it, a change of accounting date? You see that from the context, you'll be seeing here decided to account end. So you see, make you think you are doing change of accounting dates. All right, so to sum the date of change of accounting date, first of all, look for what is the company's normal accounting year end. That is what we will now call old accounting date. Then look at what is your proposed new date. These two are important. Then you look for how to file 12 months to the old accounting year. You pretend as though you are not asked to change your accounting dates. So you do that for the first year, do that for the second year, do that for the third year, and you check the total. Then come back and do the right thing by using the new dates. Same preceding year basis. And compare what you got from the old dates with the new dates to see which one of them is higher. That is what you need to pay to the tax authority. Just give me a moment, please. All right, now that we've done question number 2, the third one is question number 3. Question number 3. Now, this is Grace Limited has been in business for many years. As a result of the global economic meltdown, the business declined and Grace Limited ceased trading permanently on September 30th, 29. Okay. Now, this is the old accounting period. This question is in line with the old accounting period. So How do you do the old accounting period? You usually do something called penultimate year and ultimate year. But now we no longer call penultimate year and ultimate year, and we no longer use the rules. And so I may not solve this question number 3 because it will now make me to go into the old accounting principle, which I don't want to do with this class. So sorry. So perhaps I will revise this question in line with the new accounting finance act and send the solution to you. So, but let me give you how it is being done. How do you know your final year? Because this is a cessation of business. How do you know the year to cease business? First of all, look at the date that the business ceased operation. So here is 30th June, then 30th September 2009. Now, according to the new law, when you know this date, look for 6 months after that date. So if you're in September, October, November, December, January, February, March. So March will become 6 months into when you are going to file the due date, the due tax. So the date for due filing of the tax becomes something relevant. So that due date, your business is ending September 29. The due date to file it is 2010 March. That due date of filing becomes a relevant date for the cessation of business. So it's possible that your business will end on between January to June. Your due date will be between July to December of the same year. But once your business ends anything from July to December, then your due date for filing will be the next year. Now, let's look at the question that will summarize everything that we have been talking about. CAN Limited commenced, so I underline the keywords, commenced business on October 1, 2021. So you see, this is in line with the Finance Act, commenced business in 2021. The company chose 31st December as its accounting date. That's another highlighting principle. 31st December is the date they're using. And in the tax year 2026, the company wrote to FIRS notifying the Revenue Service Office intention to change its accounting date to May 31st. So you see, we are going to look at change of accounting date in this question. Later in the year 2030, due to harsh economic recession, the company collapsed and folded. So you see that final underlining I did here. The year 2030 is underlined, showing you that's going to be your year of assessment. How do we know that? Because the business ended in January. If the business ends between January to June, the due date for filing will be between July to December. But if your business ends in the second part of the year, from July to December, then that means your cessation year will be the next year. Now we are told to apply the rules of commencement, change of accounting date, and cessation of business to find the assessable profit for all 10 years of assessment from 2021 to 2030 in line with the provision of the Finance Act 2019, 2020, and 2021. 3 years. All right, what do we do? Let's look at the solution once again. So let's see how we can apply the commencement rule. The business started on what date again? Business started on October 1. And this accounting date is December. So the first year will be October, November, December, 3 months. And the service period is between that period. The bill date, which is the assessment year, will be 2022. So that's what we have here. Year of assessment 2022. It will be from October 1 to December 31st. But hold on a moment. There is something called period here, which you were expecting. There's also called period here, which also is there. And this one here has period. The last accounting period is having period. So how do we treat this abnormally? Now in the basis period that will guide us, we need from July 1 to 31st December 2021. What do? So this is from July 1, 2021 to December 2021. So you see, we have 18,000. Let me show you, which is this 18,000. Okay, so after that, we'll need how many months? We use another, sorry, beg your pardon. The first one will be 3 months. So what we do here is we look at that 3 months. This period here is a 1 month period. This 18,000. How do we know? Period started from October 1, 2021, and here is ending in October 31st. So that's a 1 month period. Then we need 2 more months to make it 3. It means we're going to take our 2/12 here. So if you look at it, 1 month and 2/12 to make the 3 months. You add them together and you put it in the last column. The second year, we need to start from where the first year stopped. And it's going to be till the account choosing date. And so it's a period that is not giving us issues. But if you look at it now, what's our basis period here? Our basis period is January 1, 2020 to December 31st, 2020. So you ask yourself, where can I find January 1 statement? You'll find it in this 18,000. All right, so let's look at it here. It means that this is from November 1 to the next year. What are we looking for? We're looking for our basis period, which will start from January 1, 2022. So how do we achieve that? Hold on a moment. 31st December. So here is a 1 month figure. Your January 1, 2022 can be found here. So from January to October is 10 months. So we are taking 10 months. We're taking 10 months. Then the remaining 2 months can also be written. You add them together. That's my cursor. You add them together and you have 107,500. Then you go to the 4th year and the 3rd year, which is year of assessment 2004. We ask yourself, January 1, 2023, sorry, is available. Where can I find January 1, 2023? I can find it in this 120. This 120 started in November the previous year, but I can get January to October, which is 10 months I need. Then I'll take the remaining 2 months, from 150. And that's what we did here. All right, so when you tidy it up, it gives you 87,500 plus 270, sorry, plus 20. That gives you 107 plus 0.500. The same thing for the 3rd year. The 3rd year, now, the 3rd year is what year again? Year of assessment 2025. So it means that 2025 period, we started from January 2024 to October. You will get it here. So you find a fraction 10 over 12 of 156. Then the other one here, period. You look for 9 and 10. You look at the month of 9 and the month of 10. Take it from this period figure. And that month of 9 and 10 is, sorry. That 9 and 10 is in this, sorry, it's in this place. We're looking for 2025 year of assessment. And you see here, the tax people were written in 2026. So go to 2026 year of assessment, which we are doing, and any basis period ending in May 2025, we need 10 months from there. So it's going to give you 10 months. This is going to be 12 months out of 12 times 120. Then you look for the remaining months that will make it complete. This 2026 May is when it is ending. If you look at it here, this started from we've done this period before. This started from January 1, 2024. So where can we find it? January 1, 2024 can be found here. And since this period ends in October, the 10th month, we need 10 months from here. And we'll take the remaining 2 months in this period. And that's what we did. and we have a figure here, 15714. Now that's your commencement rule, but you need to continue. And the continuation here give rise to change of accounting immediately. So the change of accounting date, you know, you have to do both the old rule and both the old account date and the new account date. Now look at the old account date. We usually submitted our account in 31st December. So in 2026, you do that with the old calendar on preceding year basis. So it means we are going to look for where we have 1 2025. Where can we find it? We can find January 1 here, and it's only 5 months. That means the remaining 7 months will be taken from here, 2026. You look for the remaining period to complete it. And that's what we did here. We took 5 months and we took the 7th month. So when we add them together, it gives us here. So the question is, why am I putting the answers in the first row, the first column to the last, when I could have done it the way I did others by putting it in the last column? This is because we are still going to be doing sum and observation. So when you do that for 2027, you look at the old dates and you apply it. And that gives you 5/12 of 126 plus 12/7 of 180. You do your maths, it gives you 1,500 and 7,500. This do it in the new dates. Looking at the new dates here, based on the revised dates, that 2026, we now go to 2026 back. Since you want to be reporting your new date in March 31st, it means that anything that starts from May and June 1, 2024, down to May 5, then May 30, 2025, will form part of 2026 year of assessment. And of course, look at the workings here, 5/12, 5/12, and the next one, 90,000, because that's for 7 months, and we are given, where is it? So that's the 30,000 here. So you added 90,000 to it. You add them up, you have 152,500. Now looking at 2017 year of assessment, you will not need to do workings because it's been given to you. That's 2027. So it happens here after the period. And so you take the figure that was given to you, and you throw it down. Put it in the second year and put it in the third year, the one that's equivalent to it. So now you add all of these and you have 458,500. That's against the first one we did of 433,286. So you see here that this is the asset value that will be used. So that's why we have the figures here. Then after the change of account continuation, you should use the new date when continuing. So it means that you've done change of accounting date, old date versus new date. Whichever wins, the new date should be used for continuation. So continuation, this is termed the penultimate year in which your business is ending. But we no longer view it as penultimate. We don't longer say penultimate anymore, because in the old rule, penultimate year used to be having 2 treatments, but now it's having just 1 treatment. So penultimate year is this figure here. This 138. Sorry, 108. 108 here. Yes, that's your new period ending in 31st March 2005. And that's what we have here. Sorry, 2018, 2008. Then the last year, which is one I want to talk a little about. The last year is the, what do they call it? The ultimate year. But we no longer call it ultimate year, we call it cessation year. Meaning that in the cessation year, you may have to file twice. The first one is based on preceding year basis, as if nothing happens. All you need to do is go to 1st of April, sorry, the 1st of June 2028 to May 31st, 2029. That's what you are considering. These 12 months, you do it on preceding year basis. But note this change, note this disclaimer. Note that the due date to file tax for this assessable period is in 6 months' time, which is going to be November 30, 2019. Okay, that's for the due date with preceding year basis. Now you need to do another one called cessation filing. Cessation filing is going to start from when the old accounting date ends down to the date when the business is going to cease. And if you look at it here, it's about how many months? About 6 or 7 months. But you just put all of them that way. Then you also note by putting the last one there is that for you to know where the year of assessment is, you must know the due date for filing this tax, which is 6 months. So any business that ends or that collapse between January to June, it means your filing date will be between July and December. But when your filing date, when your business is ending on any date from July, so that means your cessation filing will take place the next month, the next year. So the 6 months determine the year of assessment. So if your 6 months is ending you for filing in a new month, in a new year, that new year will be your last year of assessment. If it is ending in the old year, that becomes your final basis period for cessation filing. So I would like you to review all that we've done today, all that we did in the, we call it the New Finance Act, Commencement Rule, Change of Accounting Date, and Cessation. I also want you to read widely and look out for questions to solve on that. If you cannot find that, I don't know, try looking at how to understand the question in your study pack. If it is old one, try to understand it. If it is a new one, also try to understand. So I don't know if you have any question here. For the next 1 minute or so, I want to take a question. Otherwise, if in the next 1 minute there's no question, I will assume that everything was well arranged. All right, I can find out that there's no question. So if there's no question, I would like you to think about having questions which you post in the WhatsApp forum. If by tomorrow I have questions for you, I'll also drop it in that WhatsApp forum where you got the link to join the class. So until then, this is saying that you should repeat the lecture again and see how you can master basis period and accessible profit for all types of businesses, including learning the commencement rule, change of accounting date rule, and cessation rule. That will give you an edge in passing taxation. So thank you so much for coming to class, and we'll see you again in the next class when we will have with you. All right, my host, please take it away from here. You can now turn off the class. Thank you.